Credit card churning. This is the art of using sign-up bonuses over and over. Banks often offer large rewards like 80,000 or 100,000 points if a new cardholder spends a certain amount in the first few months. Churners apply for multiple cards, hit the minimum spend, collect the bonus, and then move on to the next card. The rewards can come as free flights, hotel stays, or even cashback worth thousands of dollars. The trick is in timing applications, keeping track of spending deadlines, and making sure annual fees don't eat away the profit. Some people even close cards before the second year's fee hits, then apply for a different one. Over time, the bonuses stack up into free travel or significant cashback. While it looks like free money, it requires organization, excellent credit, and careful planning. One slip, like missing a payment, can cancel out the gains with interest charges. But managed well, it's a repeatable system that feels like printing money. Buy, borrow, die. This is a wealth strategy that works best for the very rich. The idea is simple. Buy assets that grow in value, borrow money against them instead of selling, and then pass them on after death. It works well because when someone sells an asset, they owe taxes on the gain. But if they never sell, they avoid that tax. Instead, they go to a bank and use the asset, like stocks or real estate, as collateral for a loan. That loan provides cash to live on without triggering a tax bill. Because the wealthy have valuable assets, they can borrow at very low interest rates. Then, when they die, the assets pass to their heirs. In many countries, heirs get what's called a step-up in basis, which resets the taxable value of the asset. That wipes out the original tax bill entirely. The cycle is powerful. Buy assets, borrow for spending, die without selling. It's legal, it's common among billionaires, and it's one of the biggest loopholes in the tax system: high interest arbitrage. This is about finding ways to make money from the difference between what banks charge and what they pay. For example, a bank might offer 0% interest on credit card cash for 12 months, while their own savings account pays 4% interest. Take the free money from the credit card, put it in their savings account, and collect the interest until the promotion ends. Even gift card deals create these opportunities. Some stores sell $100 gift cards for $95 during sales. Buy the discounted gift card with a cashback credit card, use the gift card for regular shopping, and keep the savings plus the credit card rewards. The key is spotting these mismatches where the same company or different companies offer better deals on one side than the other. Credit card reward stacking. Reward stacking means combining multiple programs so one purchase earns rewards several times. For example, imagine buying a flight ticket. The ticket earns frequent flyer miles with the airline. If it's purchased through an online shopping portal, extra points are added. Paying with a credit card earns even more rewards. Sometimes, using a coupon site or cashback app adds yet another layer. By stacking all these systems, a single purchase multiplies rewards. For serious hackers, the stack doesn't stop there. Some gift cards bought with a rewards card earn bonuses, and then the gift card itself is used in a portal for more points. Over time, stacks turn ordinary spending into a pile of cashbacks, points, and miles. The process can feel like turning every dollar into $1.10 or $1.20 worth of value. It requires patience and keeping track of expiration date, but when lined up perfectly, the effect is like bending the rules of money itself. Arbitrage trading. This is when a person spots price differences in markets and cashes in before they disappear. Imagine Bitcoin sells for $30,000 on one exchange and $30,200 on another. A trader buys on the cheaper platform, sells on the higher one, and pockets the $200 difference instantly. In traditional finance, arbitrage has existed for centuries. Currencies, stocks, and commodities often have small pricing gaps between markets. Technology makes it faster now. Bots scan exchanges worldwide to grab those tiny spreads before they vanish. For everyday people, the challenge is fees. Transaction costs can wipe out the profit. But for traders who have scale and speed, arbitrage is almost risk-free. The game relies on efficiency. As soon as a gap appears, it's closed by traders rushing in. It's not infinite money in practice because the windows are small, but in theory, it's one of the closest things to free money that exists in markets. Cashback App Stacking. Grocery shopping can generate money instead of just spending it through cashback apps that pay people to buy normal stuff. Apps like Ibotta, Checkout 51, and Rakuten offer cashback on regular grocery items. Ibotta might pay $1 back for buying milk, 50 cents for bread, and $2 for specific cereal brands. These offers change weekly but cover everyday necessities. The real hack comes from stacking multiple apps on the same purchase. Buy groceries with a cashback credit card that gives 2% on grocery stores. Use Ibotta for another $5 in rebates. Scan receipts into Fetch Rewards for more points. Shop through a grocery store's own app for additional rewards. One grocery trip can earn money from 4 or 5 different sources. A $100 grocery bill might generate $2 from the credit card, $8 from Ibotta, $3 from other apps, and store loyalty points worth another $2. That's $15 back on necessary spending. Some people plan shopping around the highest cashback offers. If Ibotta pays $3 back for a specific shampoo brand, they'll switch brands temporarily. Others buy discounted gift cards first, then use those gift cards plus cashback apps for double savings. The apps make money from advertising and data collection, so they can afford to pay users. For families who grocery shop regularly, these apps can generate hundreds of dollars annually just from normal spending. Government relief stacking. Government programs often overlap, and some people learn to combine them in creative ways. For instance, someone might qualify for unemployment benefits while also receiving food assistance, housing vouchers, and tax credit. Each program alone helps, but together they add up to significant monthly support. During emergencies like the COVID-19 pandemic, stacking became even bigger. People collected stimulus checks, unemployment bonuses, rent relief, and business loans all at once. Some applied under multiple categories, like being both a contractor and a small business owner. While each benefit has rules, loopholes, and timing sometimes allow multiple payouts. The result can look like infinite money for a period of time. Critics argue it's abuse, while others say it's just using the system as designed. Either way, relief stacking shows how layers of programs, each aimed at solving one problem, can combine into a much larger financial advantage when someone knows how to navigate them. Extreme return policies. Some stores have really generous return policies that can be turned into free temporary use of products. Amazon lets people return most items within 30 days for full refunds, no questions asked. Costco is even more generous. They accept returns on almost anything, sometimes even years later. Best Buy gives 15 to 30 days depending on membership status. The system works like this: buy something, use it for the allowed time, then return it before the deadline. Get the money back and use it to buy the next item. Repeat the cycle and basically get free temporary access to expensive stuff. This works especially well for expensive items that only get used occasionally, camera equipment for vacation photos, power tools for weekend projects, or fancy clothes for special events. Why buy when the same money can rotate through different products? The stores expect some returns, but count on most people keeping items or forgetting about return deadlines. People who stay organized and track return dates basically get to test drive expensive products for free before deciding what to actually keep. House hacking. House hacking is a way of turning a home into both a place to live and a source of income. The simplest version is renting out extra bedrooms to roommates. Their rent covers the mortgage, leaving the owner living for free. Another version is buying a duplex, triplex, or fourplex, living in one unit and renting out the others. Because the owner lives there, the property qualifies for lower residential mortgage rates, not higher investment property rates. Some people go further, like using short-term rentals like Airbnb for maximum income, or turning basements and garages into rentable spaces. Done right, house hacking removes one of the biggest expenses in life, housing. Instead of paying thousands each month, the property pays for itself and even produces cash flow. Over time, the savings can be invested in more properties, starting a cycle where living expenses shrink and wealth grows. It's one of the most practical hacks because it uses something almost everyone needs: a place to live. Pension or benefit stacking. This happens when someone qualifies for multiple income streams in retirement. A person might have a government pension, an employer pension, Social Security, and maybe even military benefits. Individually, each is modest. Combined, they add up to a strong safety net. Some retirees optimize the timing of claims. For example, delaying Social Security increases monthly payments later. Others coordinate spousal benefits so both partners receive maximum payouts. In certain countries, people who worked abroad qualify for foreign pensions on top of local ones. When all these sources are layered, retirement income looks far bigger than expected. It's not flashy like trading schemes, but it's dependable and legal. The infinite feeling comes from the stability of checks arriving month after month from different sources. With careful planning, benefit stacking can turn an average career into a surprisingly comfortable retirement.